when they say they've met the revenue target, I would assume we would see this change in the foreign reserve numbers. The foreign reserve numbers have been growing, but not drastically, and it's been shaky.
Welcome to the Economy and Politics Conversation. I'm Ottoabasi Abasiekong. This edition will be assessing the Nigeria fixed income market in 2025. With me to have this conversation is Omaiye Okolo. She's a fixed income trader with Renaissance Capital. It's great to have you in this conversation.
It's good to be here.
Very great. The fixed income market is a very interesting market, so some very interesting conversations and what has happened in the year. First, I'll just talk about what we observed that the last two Nigeria Treasury Bills auction, the yields showed significant increase. We just want to understand Central Bank of Nigeria increasing the yields, what informed this approach, and of course, we're also witnessing Nigeria's debt restructuring. So what has inspired these actions by the Central Bank at a time that we are seeing Nigeria's debt restructuring released by the Debt Management Office?
The NTB is actually sold by the DMO and administered by the CBN. So from the early August, we've seen yields at 364 days at 1970. And of recent, the last auction that just closed, yields has gone high to about 21% yield. The idea behind this is to mop up liquidity, manage the money supply in the system, which works in hand with the CBN goal to manage a stable FX rates. So largely that's the concern. It's demand and supply. Early August, we did see the DMO overselling in the bond space. So that gave investor appetite to actually increase demand for higher yields. Because if there's more supply in the market, there will be higher rates.
So it's more about the stability.
Yes, it's more about the stability of the currency, stability of the liquidity in the market.
Liquidity is very important. So looking at it, what effects does this Nigerian Trading Bills auction yields have on companies, especially their borrowing costs in this period?
The borrowing costs for all private organizations that's looking to come into the debt market space will obviously go higher. We've seen example in Dangote Sugar that just closed on Wednesday, 180 touching about 23% yield and 1 year about 25% yield. The borrowing cost is going to keep going higher if the rates on the NTB space keep going higher, because the NTB is the benchmark rate for risk-free borrowing for investors. So if an asset manager, a fund manager could get 21% yield from the federal government, so they would definitely demand higher because there's a higher risk on the private market space. The liquidity will be strained, especially for SMEs that are looking to come to borrow in the market. They might not necessarily be able to afford the higher rates we're seeing in the market. So borrowing costs will be higher, strain. Capital project also would be delayed because those funds are actually deployed into capital projects by those private companies.
So from your experience, is this still the issue of a crowding out of the private sector? Is it much more inclusive for the private sector?
I don't think it's a crowding out of the private sector. That is an effect. It's just an effect, but it's not the goal. The goal is system liquidity management, FX rate management. And we've seen the tightening policy that the CBN and DMO has, the stance they've carried on has actually created a bit of stability on the FX market space.
Stability. Now, the federal government plans to borrow from the markets in the third quarter. We're already in the third quarter of 2025. We're expecting to see the borrowing action plan. What's your take on the approach? And of course, how will it impact liquidity for the financial markets? They are looking at revising it upward in terms of their projection.
So far, we haven't had anything of a supplementary budget. At the start of the year, the budget deficit stood at 13 trillion. And a combination of both bills and bonds that have been borrowed from the start of the year till date is about 11 trillion. So we're looking at a 2 trillion deficit. Given the cash flow, coupon payments, they're expected for the rest of the year, I think it's enough to fund the budget deficit. Emphasis of funding, but not necessarily removing. So rates will still be high as long as there's a deficit to fund. And it will strain liquidity because as those funds are been taken out of the system, liquidity would be tighter and rates will be higher. I do believe that with the momentum the federal government is taking from November towards the end of the year, we will see rates not necessarily decline at a huge dip or take a huge dip, but rates will come lower as opposed to where they are right now.
Yeah, interestingly, the president said that they've met their revenue targets and they don't even want to borrow. Though the verdict is that maybe it's foreign, not domestic, or leverage the market, but we still need to get more clarity on when he talks about no longer borrowing.
When they say they've met the revenue target, I would assume we would see this change in the foreign reserve numbers. The foreign reserve numbers have been growing, but not drastically, and it's been shaky. So I think it stands about 41 billion currently. So that should be the reflection of them meeting their revenue targets.
Let's look at the remainder of the year. What's the outlook for the fixed income market? What do you see happening from the various levels?
Oh, I think with the Q3 auction calendar for 1.76 trillion for NTB only, I do think rates will still remain high for the rest of Q3.
Interesting. And finally, for other parts, the bonds, do you see more activities happening there?
Oh, activities will keep happening because the higher yield is attractive to investors. It's good for everybody books. Higher interest rate, higher for new issue, and higher yields. Yeah, so there would be action from both investors. Investors will be interested in the bond market space as we've seen so far. I think it will continue.
So what's your word to companies and then retail investors as we wrap up the year?
I think retail investors, well, now it's a good time to go into the federal government securities. You're getting a higher yield for a later to no risk debt instrument. So for the individuals, that would be my advice. For the companies that are looking to come borrow into the market, it depends on how much they really need those funds, and because rates is a high rate system right now. I don't really know what business model you're doing that can actually give them that return. But if your return can obviously overturn your costs, I think just borrow what you need to do at that time.
Thank you very much, Omaiye Okolo. Very interesting conversations and insights on the fixed income market in 2025, and we're looking forward to the activities that will shape the remainder of the year. Thank you once again for the time.
Thank
Omaiye
you for having me.
Fixed income trader with Renaissance Capital. Thank you.
Thank you for having me.
Thank you. To our viewers, if you want to follow this conversation, log on to our website displayed on the screen and follow our social media handles. Till we come your way again, I'm Ottoabasi Abasiekong. Thank you for watching and bye for now.